Recorded. It's starting to record right now. So sure thing. I'm not sure where this is going to end up in, probably on the YouTube channel that La Rosa has, or on the their education page. So here is Lily. She is going to come in and take over and talk. You guys can all see my screen here, right? Okay.
All right, how's everybody doing? I'm Lily DeMarie. So we're gonna take a look at step-by-step at a closing disclosure. This is a borrower that I closed last week, so it's very recent. All the fees are super recent. Okay, so this is the first page of the closing disclosure. Okay, so the top part is just general information, when it's gonna be the closing date, the date that the closing disclosure was issued, who's the settlement agent, meaning the title company, the seller, the lender, was the sales price, and on your right-hand side, you're gonna see the loan term. So this part is really important. So that you're gonna know what type of loan it is, how many years, if it's fixed. So in this type of loan, we're doing a 30-year purchase. It's a fixed rate, and you're gonna have a check mark here on conventional, okay? Because this is a CD for a conventional loan. All right, so the first part is the loan terms. Most important, the loan amount. So on a conventional loan, the loan amount is very, very simple, okay? Just purchase price minus the down payment. That's the loan amount. In an FHA loan, it's gonna be a little different and a little bit more complicated for the client, because the loan amount is gonna be your purchase price minus your down payment plus your mortgage insurance premium. Okay, so this is a big confusion with clients, because what they do on the loan amount, they just, on an FHA loan, they just take the purchase price and minus the down payment, and it's never gonna match. So they get super confused. And it's only because on an FHA loan, they're adding the mortgage insurance premium to that loan amount, okay? All right, so here is also letting you know if this amount can increase after closing or no. So the loan amount is never going to increase, it's always going to be the same. Interest rate, this is a fixed loan, so the interest rate is never going to go up, okay? It's always going to be, in this case, at 3.25, so it's not going to increase. What's your monthly payment? So your monthly payment is just here, the monthly principal and interest, very important. This is never going to change. So when a client asks me, and this is a question they always ask me, is my monthly payment going to go up? Okay, so my answer is monthly principal and interest will not. Very important. Principal and interest will not. Can the monthly payment go up? Yes. Monthly principal and interest go up? No, it will stay the same for the life of the loan, okay? Is there any prepayment penalty? Okay, so right there, no, we do not have any prepayment penalty on the loans, but we'd like the loan to be paid for at least 6 payments, after they close, okay? So if they close, we would like the client to make at least 6 payments before they sell or they pay off their loan. Any balloon payments? No. Okay, so what are the projected payments, and why do we have 2 different projected payments? You see how the first tells you what the monthly payment is going to be from year 1 to 9, and then on the other side you're going to see what the payment is going to be from year 10 to 30th. Okay, so like we say, the principal and interest will stay the same for the life of the loan. It's not going to change. $732.01 from year 1 to 9, and $732.01 from year 10 to 30th. Now let's talk about the mortgage insurance. Okay, the mortgage insurance is going to stay from year 1 to 9. This is a conventional loan, right? So if they pay only what they're supposed to, on year number 10, the mortgage insurance is going to fall off. Okay, but now keep in mind, if they want to put extra payments to principal, if they want to pay more towards principal, that mortgage insurance is going to be able to, come off earlier. Okay, so the reason why it says year 10 to 30th is because in this case, we're only having the, or, you know, this is when the client or the borrower only pays what they're supposed to, okay? Now, again, if they want to pay more towards principal, that mortgage insurance is going to come off earlier on, okay? Now, your estimated escrow. So what is the escrow? So the escrows are your taxes and your insurance, okay? And like it says that down there, right below it says estimated escrow, that amount can increase over time, okay? Why? Because if your property goes up in value, your taxes are gonna go up. If the insurance goes up, your monthly payment is gonna go up, escrow is gonna go up, okay? Okay, so the estimated total monthly payment, $986.31 for the first 9 years, and then it's gonna go down because we're taking the mortgage insurance out, okay? So when the client asks you, is my monthly payment is gonna go up? You know, a lot of people say, no, it will never go up because it's a fixed rate. It's very important for them to know principal and interest will never go up because it's a fixed rate. But mortgage escrows might go up. So the monthly payment can change. Okay, so this part underneath where it says estimated taxes, insurance, and assessments is a little bit confusing for the client. They sometimes think that $149.18 is additional to the $986.31, and it's not, okay? It's not extra. That part of what it's telling them is what your actual estimated taxes, insurance, and assessments come up to, okay? So the taxes and insurance are included on the $149.18, and they're included on your escrow. But then any other, if in this case nothing else is included, there's no HOAs. But if there's any HOAs, then that amount is gonna be different to your escrows. So if you see on the top part where it says estimated monthly payment right here, I don't know if you can see my little hand right here, my little pointer. The $149.18 is that same $149.18 right here because it's property taxes and insurance, which over here is included on the escrows. But if you have, let's say, an additional $100 on HOA, now this monthly amount is going to be $249.18. And the only thing that is going to be paid in addition to the monthly payment is going to be that $100, okay? Okay, so this part is also very important because what your client has to look for is not the closing costs, is not the total closing cost, is the total cash to close. In this particular case, the client had actually a little bit of money back, and I'm gonna explain the reason why earlier on, but what they have to look is what the cash to close is, not the closing cost. And the reason why not the closing cost is because this is the total closing cost, and most of the times is not including the credits, okay? So we don't want the client to be alarmed because this is too high, okay? We always want to point them to the cash to close. That's the money they have to bring at closing, including their down payment and their closing costs. Okay, closing cost details. So this is everything that is added and that totals your closing costs. Okay, so let's start by pointing out what the origination charges that we, Union Home Mortgage, have. Okay, so the underwriting fees are $1,125. That's including the underwriting, the processing, everything that we do to close the loan from beginning to end, okay? $1,125. To tell you the truth, this is a pretty good amount. I've seen them pretty high. I've seen them up to $4,000 in origination charges or underwriting fees, okay? So be very, have your clients look at this very closely when they're shopping around with brokers, most likely, because brokers will have an additional fee there that is going to be very high, okay? So our loan costs, like origination charges, are, for me, are excellent, because I've worked with all the lenders before, and I've seen a lot of other closing disclosures from other lenders, and 1267 is actually a very reasonable charge. Okay. Okay, number B is going to be the services the borrower cannot shop for or did not shop for. Okay, so the appraisal fee. Okay, the appraisal fee, you see that is on the column that it says before closing, paid before closing. And the reason why is because the appraisal is paid up front. Okay, it's the only fee that they have to, one of the only fees that they have to pay up front. And that's the reason why we're not adding it to the closing cost. We're actually putting it on before closing or paid before closing. Probably the reason why you see a little minus 25, maybe the client overpaid a little bit on the appraisal. Maybe we thought that the appraisal is going to be a little bit more expensive and it wasn't, so we're giving them a refund at closing for $25. Okay, so we have the MERS registration fee and the tax services. This is all, you know, just to pull reports, okay? So we're pulling like the transcripts and the, we have another report that is called the fraud report. So all those types of report are in there. Now, the credit report is charged upfront with the appraisal fee. Okay, so we're going to give the client a one-time fee, let's say $500, and that's going to be including your appraisal. Actually, here is a little bit more, it's like 525, 523, something like that. It's going to be including your appraisal and your credit report fee. Number C is the services that the borrower can shop for. Okay, so the survey, most of the times the title company is the one that orders the survey, right? But keep in mind, if your client has a survey or the seller has a survey that is willing to give to your buyer, they don't have to do a survey, and that fee can be like $0. Or your borrower can actually, if they know somebody or if they have worked with a surveyor before, they can actually buy the survey themselves. They don't have to go through the title company. Okay, so all this numbers, C is all title fees. Okay, what the title company is going to charge, like the settlement fee. That's how much they charge to do all their, you know, all their paperwork and their closing and the transaction. Okay, so other costs, taxes and government fees. So this is what the government charges to do all the recording and the stamps and the transfer taxes and all that. Just keep in mind, almost all of the transactions, the transfer taxes are paid by the seller. So that's what we call the doc stamps on the deed. Okay, so most of the times we disclose the transfer taxes on the buyer's side, but we have to take it out at the end on the closing disclosure. It has to go. And so that's why you can see here how the 1213 is actually on the seller side, seller paid. Okay. All right, so the prepaids. The prepaids are things that the borrower have to pay up front. Okay, so in this case, our homeowner or our borrower pay their insurance up front. You don't have to if you don't want to, but if you're a little bit short in funds and you need your closing or your cash to close to be a little bit less, you can always pay the insurance up front, okay? You don't have to, again, the borrower does not have to pay their insurance up front. But in this case, they did. And that's the reason why it's in the line that it says paid out of closing, the 1,110, okay? Okay, so the prepaid interest, you're going to see the amount of days that from when we close until the first payment are gonna be right here. The reason why we don't have anything is probably because they closed the very first day of the month, and probably they were giving like a little refund. So that's why they're not paying any prepaid interest right there. The initial escrow, so it's going to be what we collect up front for your escrows, your insurance and your taxes. So because it's the end of the year, we actually going to collect the whole year of taxes, okay? The reason why is because we pay for your taxes, or the lender pays for your taxes in November, okay? So the bill comes out in November. So we have to collect from the borrower the whole year so that we can pay for the taxes in November. But then you're gonna see a credit given to the borrower on page 3. I'll show you that a little later on, okay? So homeowners insurance, we always have to collect at least 2 or 3 months in escrows. And then the taxes we collect depending on when the closing is. Okay, so let's, for example, if the closing is on December and the seller had already paid their taxes, we only gonna have to collect around 3 months, okay? All right, and H is for any other type fees, like your transaction fees from the realtor. So this is where you're gonna go look and if your transaction fee has been charged, okay? Now keep in mind that you get a different document from the title company. You guys get your ALTA statement, okay? The ALTA statement looks a little bit different than the CD, but should match at the end. So the cash to close should be exactly the same to the penny. Okay, and the title, the owner's title policy will be charged in this line as well. Okay, so this is the total of number I, and then J is the total closing cost. So in this case, around $5,699. Okay, so here is a little bit of calculating your cash to close. We always gonna compare what the loan estimate, which is the very first document that goes out to your borrower. Okay. Oh, I'm sorry, somebody was asking me, what is the tax service on line B8? So the tax service is what we charge to order your transcripts from the IRS, okay? That's the tax service. We pay a third-party company to request the transcripts from the IRS. Paying the, have another question. Paying the home insurance upfront will reduce the monthly payment? No, it would not reduce the monthly payment, okay? No. The reason why you always have to pay your insurance up front, even if it's at a closing or even if it's inside of the CD, if it's included on your closing costs, you always have to pay an upfront insurance premium. What is called the insurance premium? Why? Because the insurance companies want to have a full year up front. They want to be paid up front. Okay, it doesn't mean that you don't have to make monthly payments on it. You still have to pay your insurance every single month so that your lender can pay for your whole year of insurance the next year. Okay, keep in mind that insurance, the home insurance, is paid up front. Okay. Okay, that homeowner's insurance F is paid monthly, additionally to their mortgage. Yes, so the homeowner's insurance is paid monthly. What they do is, for example, if your insurance, your homeowner's insurance is $1,200, okay? That means that you have to pay $100 a month, right? So you have to pay the insurance company a premium. So you have to pay them the $1,200 up front, okay? They want to be paid up front, the whole year in advance, okay? Now you have to include that $100 into your monthly payment because coming next, let's say November, let's say you close November, coming next November, now you have to pay your insurance again for the year to come, okay? So you're always gonna collect $100 a month for the year to come because you always have to pay your insurance. Well, your lender has to pay your insurance every year. Okay, so now we're back to our CD. So calculating cash to close, right? So we're gonna compare the loan estimate, which is the first document that came out the very first time your client signed disclosures, and your final CD. You wanna see, you know, is it too high? What's going on? Is it so? In this case, we see the closing costs are a little higher, but the cash to close is much lower. So the client is gonna be very happy because now he doesn't have to bring money to the table. He actually is getting a little bit of money back. Okay, so the total closing costs are $7,332. We're gonna be deducting your closing costs paid before closing. So in this case, where the appraisal, where I'm gonna go up here and look, is the credit report fee and the insurance, okay? So that's the $1,633 right here. Now you're gonna add your down payment, right? So your down payment is $5,203. And now you're gonna take out the deposit. So that's the escrow deposit, okay? So you're taking out your escrow deposit. Now you're gonna put in the seller credit. That's just in case the seller is giving any type of seller concessions. In this type loan, yes, they had $5,000 seller credit. So you're putting your seller credits right here. You're deducting it, right? And now your adjustments. Also, all the adjustments and other credits, you're gonna see them on page 3. So I'm gonna show them where all the adjustments are coming from. So in this case, our $4,000 in adjustments, and that's the reason why the client is getting some money back. Okay, so here's where we're gonna see all the adjustments. Okay, so this is the summary. So we have the sales price, and we're adding all the closing costs. Okay, and we're gonna be adding it some adjustments. So these are what the seller has paid in advance. Okay, so keep in mind that part of the taxes, part of the tax bill. Okay, part of the tax bill. Some of the part that the tax bill is paid by the seller in advance, okay? So in this case, it's $74.76 that the buyer needs to pay the seller, okay? So I think that's the non-ad valorem taxes. So if you go to the tax bill, you're gonna see that the tax bill is gonna be divided in the ad valorem and the non-ad valorem. Okay, the ad valorem are always more expensive. They're a bigger part of that total amount of the taxes, and the non-ad valorem is a small part. So the non-ad valorem are paid at the beginning of the year, and that's the reason why the buyer owes the seller $74. Okay, so now we're adding the sales price to the closing cost and the ad valorem taxes, the taxes that the buyer owes the seller. So that's what's due from the borrower at closing. So it's $179 was $73. Sales price plus closing costs plus the adjustments for the seller's items paid in advance, okay? Now we're gonna see what things are already being paid in behalf of the borrower at closing. Okay, so we have the deposit. Why? Because the borrower has already given those $3,000 to the title company, right, in an escrow check. So it's the $3,000. Now the loan amount. Why? Because that's the amount that the lender is going to give to the borrower. It's $168,198. let me finish. I have a lot of questions, so let me finish up right here, guys, and then I'll answer your questions so that we can go back on what you guys are asking for, okay? That's for Katie, that you're still asking me about the insurance. So let me just finish up right here, Katie, and then I'll go back to you. Okay, so the loan amount is $168,198. Now the seller credit, okay, that's a plus to the buyer because that's a credit that the buyer is giving from the seller. So that's $5,000, okay? The title premium, they always get a little bit of a credit from the title policy, okay, from the seller side. And if there's any gift funds, in this case, there was a family member that was giving some gift funds to my borrower. Okay, so there were $3,000 gift from the borrower, and the wire was already given to the title company. So that's why we're giving a credit for $3,000 here. Now, adjustments for items unpaid by seller, and here is where the seller will give the buyer a credit for the taxes. Why? Because the ad valorem taxes are paid in arrears, meaning they are paid at the end of the year. So the seller will have to pay the buyer for, let's say if we close in November or in October, the seller will have to credit the buyer from January, February, March, etc. until the day of the closing, because the seller have lived in the property and they have not paid for those taxes yet. Remember, the taxes are paid at the end of the year, the ad valorem taxes. So they have to give a credit to the buyer for those taxes, okay? Because I am collecting for the whole year, right? But the buyer has not lived in the property for the whole year. That's why the seller has to give them a credit. Okay, so now we add all of those, and that brings the total to $180, $348,065. Okay, so now what we do is we're going to take the borrower, the due from borrower at closing, 179, 173, and we're going to subtract it to the paid already on behalf of the borrower, 180, 348. And that's the reason why we have cash to borrower. So we're giving them a little bit of money back, 1,174. Of course, this is not something that we see every day because we don't see a lot of gift funds and a lot of seller credits, right? We don't see them very often, and so we don't see a lot of borrower getting money back. So this was a really nice deal for the borrower here. But most of the times we're going to see cash to close from borrower. So most of the times the borrower needs to bring that cash to close. Okay. Now let's go back. This is the end of the closing disclosure. So let's go back to some questions. So Katie, you were asking and you were saying that you were a little bit confused. So I'm still a little bit confused. Does the buyer pay 12 months plus 2 months at closing? You're talking about the taxes. So, or you're talking about insurance. So if you're talking about insurance, yes. So insurance, you have to pay a premium. So your insurance company is going to ask you for an upfront premium. So yes, you will have to pay for the full year upfront at closing. Plus, we as a lender gonna want to have some reserves. So we'll collect 2 months of reserves, right? And the reason why we need those reserves is because, for example, let's put the $1,200 example again, where let's say your insurance is worth $1,200, right? And we collect $100 every year. For example, let's say of course, this is a law. You have by law to collect reserves. But for example, let's think that we did it. Okay, so we're collecting $100 every month, and then in November we have to pay $1,200 to the insurance company. But what if the bill from the insurance company is not longer $1,200? The insurance went up on your property, and now your insurance is $1,300. We're short. The lender is short in funds. So we cannot just go back to you and say, hey, we're sure we really need to pay this insurance bill by tomorrow, but we don't have enough money, so can you send us a check? So we can't do that, and that's the reason why we collect 2 months or 3 months in reserves, just in case your taxes or your insurance go up and we didn't collect enough money. We now then have to take money out of that escrow account or that money that we have in reserves to be able to pay the tax or the insurance bill. Okay, so yes, we always have to collect those escrows up front. Okay. Diana Torres is asking, there's an agent waiting to be let. Okay, I'll let them in. Thank you. Is this been recorded? Yes, it's been recorded. Okay, Lily, I have a question that is not on your CD because your CD doesn't have homeowners association. It is normal for a borrower to pay a charge from HOA in the stubble letter? Yes, yes. So you will see it, I'm gonna go up here, and you will see it on other, on number H. That's where you're gonna see all the HOA fees. So yes, if for example, the HOA is paid up front. Let's say the HOA is paid up front. The seller pays for the homeowner's insurance in January for the whole year, for example, right? And you're closing in November, right? Or you're closing in June, for example, right? Now your buyer owes the seller, you know, the rest of the year. So let's say June, July, August, September, October, November, December, right? Because why? The seller paid for the whole year up front, right? So on number H, you're gonna see right there where you're gonna be getting those credits, or probably you're gonna see those credits in the adjustments over here. Now, if you have to pay the HOA a fee, sometimes the HOAs will charge like a transfer fee. You know, you're gonna see it right there. Also, you're gonna see this topos fees right here. Anything that is fees from the HOAs, you're gonna see on number H where it says other. Any fees that the buyer has to pay the HOAs, okay? Like transfer fees, like capital contributions, like stopple fees, you're gonna see it on number H. Now, what I was talking about, if the HOA is paid up front and they need to give a credit to the seller, you're gonna see here in the adjustments on number 3. Okay. So this is pretty much everything that we have on the CD. So it is so important for you to just take a look and, you know a little bit about what is the, you know, what entails. Now on this page, you're gonna see the amount that the buyer is gonna be paying in, you know, in interest for the whole year. So you're gonna see all the finance charges. You're gonna see like the total amounts they're gonna be paying for the loan at the end of the 30 years. You're gonna see it on the very last page, okay? And there's really only one signature on the very last page. Okay, so very important, it is all your prepaids. So I always, as a lender, I always look at my page 3, okay? Because I want to make sure that the title company has not missed the credits, okay? So if the seller is giving a credit, you have to make sure it's in there. If there's some gift funds, if, like I said, the taxes, so the credits, because I myself want, of course, my buyer to pay as little as possible, right? So I want to make sure that all the credits are in there. So it's very important to go to page 3 and look at the credits, okay? Besides that, very important also to look at your page 1. Page 1, loan terms, that is fixed. That's all something that they always ask me, is this a fixed rate? Yes, you're gonna see it on page 1, right on the top, fixed rate. and that is a conventional loan, and what the interest rate is going to be. Okay, so also interest rate and APR is something that they ask me a lot. So the interest rate is actually what your monthly payment is based off, is your interest rate, and your APR is just how much the loan is gonna cost the borrower. Okay, so it's very different than the interest rate. So your borrower always have to look at the interest rate if they're gonna know what the monthly payment is gonna be, and the APR if they want to know how much the loan is gonna cost them. Okay, so the APR, you're gonna see it right on the very last page. I think the very last page, yes, the page number 5. You're gonna see it right here, the annual percentage rate. I know some clients ask about it, is right here. Okay. All right, so this is pretty much it. I hope that you learned a little bit on how to read SCD. If you have any other questions, please let us know. You can text us. I think that's the easiest way for us. Just send us a text. I know that I have a couple of people that came in a little late, and I was going through a little fast. So if you have any questions or you want us to go ahead and give you some people joining still. So if you want us to, it's been saved, right?
It's being recorded. Yes.
It's been recorded, yeah. So if you want to hear it again, or if you just want to give us a call, or if you want us to give you the class again, we'll be happy to do so.
Show a few other things real quick here, guys. We do a morning video every day. You should see this in your My Agent account. So there, I try to keep these videos under 4 to 5 minutes, talking about mortgages and in the marketing world. You know, I handle the marketing for our team here. So this should get emailed to you on a daily basis. I try to keep them as informational as possible and as short as possible for you guys. We created a website here. This is just an image of it, but you can come here to see what the loans are. This is all at lilydemarie.com. There's calculators, resources for realtors, the list of the documentation, everything they need is going to be in here. Ways to contact us, of course. We are on Instagram, mortgage_DeMarie. Our morning videos are backed up on YouTube. Just type in my name. Feel free to follow us there. The videos I post in the morning are actually on there at nighttime. I post them the night before, and then I'll post them at like 7 in the morning, maybe the day after. Next Monday at 12 o'clock, I'll be doing a class on Facebook ads and Instagram ads. We're going to start at the beginning. This is a basics class, more designed for anybody that hasn't run Facebook ads before. This will eventually morph into a workshop where we compare results and, you know, show the things that are working, things that aren't working. It'll take a couple of weeks for us to get into more advanced techniques, just because not everybody has run these types of ads before. If you've run Facebook ads before, you may not need to really sit in the first class or two, but who knows, maybe you learn something anyway. And this is how you get in touch with me, or well, Lily as well. This is my phone number here. You can text me here if you want. You can email me here. If you have anybody that wants to fill out an online application, they can do that right here as well at unionhomemortgage.com. We run everything through Lily's profile. If you're not on list reports, you definitely should be. This is free marketing stuff for you guys. It's a service that we pay for out of pocket that you definitely, sorry, I got dogs fighting in the background here. We all still working at home. And so if you want to email me right here, your photograph and your website, your social media, and your KV Core page especially, we will add you into list reports. And therefore, if you have any open houses, or if you want to do an open house in another realtor's open house, you can make all unique marketing materials for that. So anyway, guys, do you have any questions for me? Lily had to run off, take a phone call, but that's all we have for you today. And, you know, we try and keep these classes under an hour if possible, just because, you know, we know you're commission salesmen. We respect your time, and we try to deliver the highest quality of value to you guys in the least amount of time, you know. So again, you can always reach out to me. If you want to email Lily, that B turns into an L, DeMarie at unionhomemortgage.com. And that's about it, guys. You guys, appreciate you spending some time with us today. Thank you very much. This will be recorded. I will post today after I ask, I'll ask Ryan where that is going to be posted, so you guys can come back in and take a look at it if you came in late, all right? So anyway, guys, enjoy the rest of your day. That Apple announcement starts in 15 minutes. If you're into that kind of thing, I always like to watch those. Those are always fun. So anyway, appreciate your time today, guys. Thank you very much for joining with us.